Hello, I'm Emma Lou Montgomery. Welcome to Stockwatch Live. It's been stop-start of late at the AA. However, the breakdown recovery and automotive services firm insists that profits will come in at the top half of expectations after it re-won a number of its key contracts and saw customer spending rise. The Automobile Association said that full-year profits will be not less than £340 million. Previously, it said the figure would be somewhere between 335 and 345 million. Analysts had £338 million penciled in. Midway through something of a recovery of its own, bosses at the self-styled Fourth Emergency Service admit there is work to be done. The number of personal memberships is continuing to fall. So far, they're down about 2% to 3.2 million over the year. The company has blamed the decline in paid members on its rephased summer marketing campaign, as well as the impact of regulatory pressures and continued competitor activity. Plans are in place to remedy that though, and the group has said its membership base should be broadly flat by 2020 and return to growth by 2021. However, the AA is now more than a breakdown company, which it has long been keen to shift its focus onto. The far larger and far more profitable part of the business is the business contracts division, which provides servicing packages for a number of major car manufacturers. This side of the business accounts for around 10 million of the breakdown group's 13 million customers, and it's also where revenues are growing. Average income per business customer has been rising by around 5%. And over the past 9 months, it has won or renewed all of its major business contracts, including those servicing Volkswagen, Lloyds Banking Group, Jaguar Land Rover and Suzuki. Also growing is its insurance division, which it has described as delivering strong growth. Motor policies were reported to be up 16% at the last count, while home insurance was also back into growth territory, up 1.5%. No doubt when the AA posts full-year figures on Wednesday, investors will be all ears when it comes to seeing whether those trends have continued and whether paid membership decline has started to come under control. It has been managing to maintain its renewals at just over 80%, and when it last revealed average income per paid member, it was around £162, which was 3% better than the previous year. Neither Credit Suisse nor Peel Hunt have revised their views of late. Credit Suisse rates the shares underperform and has cut its price target from 100 to 70 pence, while Peel Hunt rates the shares a buy. One company that needs someone or something to come to its rescue is Topps Tiles. The challenging market backdrop that saw its sales slip in the first quarter has seen Britain's biggest tiles retailer struggling to find a footing. A shift into the commercial sector has been mooted as a potential lifeline for the group, which is still widely regarded by analysts as a barometer of people's willingness or not to spend on big ticket purchases like kitchens and bathrooms. Topps, which is due to give a trading update on Wednesday, said it was excited by the opportunity for profitable growth. It says it's recruited an experienced sales force and will be looking for other ways to further strengthen the team. Part of that plan should have seen 2 new showrooms open during the second quarter, bringing the total to 4. Whether that will be enough to turn things around remains to be seen. The shares have stuck in the 60 to 80 pence range for the past couple of years. Broker Cantor Fitzgerald has retained its hold rating, but clearly isn't expecting anything truly transformative, having trimmed its price target 5 pence to 70 pence. And at least it hasn't been as scathing as JP Morgan Cazenove has about Saga, the over 50s travel agent and insurance group. Saga shares have plummeted after the broker put out a note downgrading its investment rating on Saga to underweight from neutral over worries about competition. In this note, analysts said basically that Saga faces a double whammy of increased competition on the motor insurance side, coupled with increased debts on the holiday side of the business over the next 2 years as it funds 2 new cruise ships. Having recently taken delivery of the first ship, the timing of this downgrade took the shares plunging to new depths. The big worry for investors is that all this outlay and revenue crimping will mean Saga has to pull the plug on its dividend payout plans. And that won't please Saga investors. Having plunged to an all-time low in December 2017, when the collapse of Monarch Airlines forced it to rebook flights for its customers, Saga shares really haven't recovered since then. After a choppy 12 months, the shares are now pretty much back where they plummeted to. Cutting its price target 20 pence to 120 pence in this latest note, the broker argues that with several of the larger UK motor players who have reported of late all saying industry pricing is failing to keep pace with claims inflation, Saga is going to struggle. It added, given that Saga is seeking to return to policy growth after many years of declines, this is an unhelpful backdrop. Saga, which is due to post full-year results on Thursday, said it had continued to trade in line with its expectations during its second half, but it has acknowledged pressures on profits in the insurance division, which it has seen between the 1st of August 2018 and the 15th of January of this year. However, it said that was offset by another strong result in underwriting, continuing a trend also seen in the first half. Saga has said in the past that customer acquisition is key, and that it would cut prices if need be to pull new customers in. Investors will hope that Saga isn't forced to succumb to the same pitfalls of so many in the similarly beleaguered retail sector in these challenging times, namely chasing customers at the cost of all else. Well, that's all for this week. For coverage of the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.